There we go. Perfect. All right. So we are recording this, just so you know. But what we're going to talk about is mortgage rates, the mortgage rate environment, and really what causes rates to move the way they do. How does the Fed, what they're doing, how does that change rates? How does that interact with rates? And here's the reason I wanted to talk to this and really kind of give you some talking points is it's super easy for me to tell you, hey, look, if your clients ask about interest rates, just have them call me. I'll tell them what's going on. And yeah, that works all well and good, except for one thing. You're in the car with the client. You're out, looking at homes with the client. I don't care what we do. You're going to get asked questions, right? Like you're the person they ask the home inspection questions to. You're the person they ask the title questions to. You're the person they ask the mortgage questions to. So given that, with what's going on in the media, interest rates kind of creeping up a little bit, I think it's important for you to be able to talk to your clients, and at least when they ask questions, be able to move that conversation along. And of course, you can end it up with, hey, but you know what? You really need to talk about specifics with your mortgage lender. Okay, so what we're going to talk about is what the heck is up with mortgage rates. And I have been asked that question numerous times. And some of y'all don't say heck, just so you know. Some of y'all phrase that a little bit differently. But anyway, so we'll jump into this. If I can get this going. There we go. All right, so basically we're going to talk about secondary market loans versus in-house bank loans. What is a mortgage-backed security? What's the note rate versus the interest that gets passed along to the end investor? All that. Okay. So real quick, secondary market loans versus in-house bank loans. So the types of loans that I do and most mortgage lenders do are sold on the secondary market. And the way we're able to provide what typically is better interest rates than an in-house loan at a bank is just simply we're taking like-kind products and we're moving them to in a group to investors. And because we're taking like-kind products, because there's some underwriting criteria that we're adhering to, those investors are willing to take a little bit less return because they feel their risk is a little bit lower. Versus if you take, and I'm not picking on any bank specifically, but if you take a small community bank that does an in-house loan, and let's just say they do a 90% loan for their clients, they are loaning their money specifically. They are not turning around to sell that to somebody else. If that deal goes south, they're 100% on the hook for that. Okay. And so, with that said, they have to price in a little bit more the risk there. Okay. So when we talk about interest rates fluctuating, we are mostly talking about secondary marketing stuff. Okay. Now, what is a mortgage-backed security? That is basically where lenders package up these loans and turn around and sell them on the secondary market. If you have mutual funds, you probably have mortgage-backed securities in some form or fashion in one of your mutual funds. I sometimes jokingly tell clients, like, you might even own a portion of your own mortgage, strange as that sounds. But it's called a mortgage-backed security because it is an investment vehicle that is essentially backed by these mortgages. And again, the homes are used as collateral, so they're considered to be a little bit safer. Now, note rate versus interest that gets passed along to the end investor. This is an important concept, I think, to understand, to really get, why rates move the way they move. And so here's how I want you to think about it. If, and I'm just going to use, I'm not quoting rates today. I'm just using easy numbers to think about. If the rate that a consumer gets on a mortgage loan is 5%, most likely that end investor, after it goes through Wall Street, after it goes through the lender, after everything's done, the end investor probably gets somewhere around 4% return. Okay. So I want you to think about the idea of someone is going to take $200,000 of their own money and lend it to somebody else for potentially 30 years and only get a return of 4%. Okay. Now, understand something. When rates were in the low threes, let's say if a rate was 3%, the way I would explain it to customers is you have to understand the person that's providing this money, they are literally only getting a return of 2% over the next 30 years. And at most, they're getting a little bit of principal payback every month, right? So that at the end of 30 years, their loan is fully paid back. But their return is literally 2%. And so if you think about that, if I came to you and said, hey, listen, you've got $200,000 extra dollars. I've got this awesome investment vehicle that I want you to participate in. And you say, well, what's the return going to be? And I'll go, listen, this is the best part. It's 2%. You're going to go, you're nuts, dude. I could go somewhere else and get a better return. Okay, that's what you have to think about when you think of mortgage rates. All right. And so when rates were as low as 3%, it was incredible that rates were that low, given the fact that someone had to give up some money and get a lower return. Now, this is key in this discussion. Okay, who buys mortgage-backed securities? Big hedge funds do. Like I said, if you've got a mutual fund, you've probably got mortgage-backed securities in the mutual fund, and the federal government also purchases mortgage-backed securities. And so why does that matter? Well, the Fed back in 2020, when at the start of the pandemic, the Fed realized, hey, we have a potential problem with the economy. There's going to be a shutdown. We don't know the overall effect of that. And so the Fed started a plan to purchase mortgage-backed securities, and they essentially said, we're going to buy as many as it takes to keep interest rates low. Okay. So make no mistake about it, the Fed was absolutely manipulating the market so that interest rates would remain low. Now, we can debate whether they should or shouldn't have been doing that, and that's not the purpose of this discussion, but that is, in fact, what they were doing. So now, the next thing on this slide says, what influences purchasers of mortgage-backed securities to take a higher or lower rate? Well, for the most part, it comes down to this. If the feeling is that prices in the future are going to not be dramatically higher than prices today, an investor of a mortgage-backed security would be willing to take a little bit lower return. Hence, a 3% mortgage rate, they're really getting closer to a 2% return. Why are they willing to do that? Because they thought the economy was shot. They thought, well, man, my other option is to put it in the stock market. And at that time, the feeling was that may not be a sound investment because we think the economy is that bad. Well, what influences a mortgage-backed security purchaser to want a higher rate of return? When they start seeing inflation, right? Because when they start seeing that, well, wait a minute, now I think prices are going to be 7% higher, 8% higher, 10% higher down the road. Well, now that 2% return doesn't sit so well, okay? And so other investors, other than the federal government, they have to look at those things and they have to expect a higher rate of return. The federal government, on the other hand, although, yes, they would like a higher rate of return, but really and truly, that wasn't the purpose of them purchasing mortgage-backed securities. And this all kind of correlates as we move along. So, all right, the next slide here, what would be considered a short-term interest rate versus long-term rate? Let's talk about this because this really plays into the million-dollar question that you're going to get asked is hey, what's the Fed doing? Like, what's the impact they're doing? So the Fed controls short-term interest rates. All right. So what's a short-term interest rate? Home equity line of credit, car loans, credit cards, things like that. Okay. And so what causes short-term rates to go up or down? For the most part, it's tied, very directly to what the Fed does. So when the Fed meets, and you've probably heard news stories of the Fed is meeting and they're going to raise interest rates. Okay. So when the Fed meets, they raise what's called the Fed funds rate. Okay. As a matter of fact, I'm going to click over to the next slide. So they control the Fed funds rate. That's the short-term interest rates. Okay. The Fed funds rate is currently at 0.5%. All right. Prior to, I think their last meeting, it was pretty much at 0 to 0.25. All right. So they influence the Fed funds rate. and I'm not going to bore you with a bunch of details on that, but basically you've probably heard the term prime rate, right? Like a lot of times home equity lines of credit or credit cards are tied to prime. Prime is always 3% above the Fed funds rate, okay? So the Fed doesn't technically change prime rate. They change the Fed funds rate, which in effect directly changes prime rate, okay? So prime rate currently is at 3.5%. When the Fed raises rates or lowers rates, that does not directly change interest rates, okay? I'm going to say that again. When the Fed raises or lowers rates, that does not directly change mortgage interest rates, okay? Now, why do mortgage rates change at the same time, okay? We're going to talk about that, but it's not a direct effect. It's very much correlated, okay? Very much correlated, but it's not a direct effect, okay? So why do mortgage rates change or seem to change when the Fed changes the Fed funds rate? Here's why. The reason the Fed is manipulating the Fed funds rate is because of factors taking place in the economy, okay? Those exact same factors are what mortgage-backed security purchasers are looking at to determine what sort of return they want on buying mortgage-backed securities, okay? So here's the deal. When the Fed raises the Fed funds rate, they're trying to slow down the economy. Why would they be trying to slow down the economy? Well, if they think that inflation could be a concern, they would want to slow down the economy. And you have to understand the Fed has two goals for the most part. Low unemployment, okay, which they're pretty much hitting the mark there, and control inflation. They're not hitting the mark there, okay? But that's their two goals. So they don't love raising the Fed funds rate. I mean, in theory, you would love that to always be low. You'd love, money to always be cheap. Let people buy, and that helps the economy. But it can get too far out of control, too far the other way, and you can have inflationary problems, okay? So when the Fed is increasing Fed funds rate, I'd say 99 out of 100 times, mortgage rates are going up at the same time because guess what? The people that buy mortgage-backed securities are going, wait a minute, we think inflation's out of control. Oh, and lo and behold, that's when the Fed steps in and starts raising the rates, right? They're both reacting to the same things. Incidentally, if the Fed lowers the Fed funds rate, they are probably trying to push the economy to do better. Well, they don't generally do that if they think the economy is just smoking hot, right? So there's probably things going on at the time that they lower the Fed funds rate that causes people to think, man, I don't know, this economy looks like it's kind of shaky right now. Those same factors might cause mortgage-backed security purchasers to say, you know what, I'll accept a little bit lower rate of return because I'm concerned about the economy. Well, I don't want to throw my money in the stock market right now because I'm concerned about the economy. I want the safer investment. I want the mortgage-backed securities, okay? So that's why mortgage rates seem to change around the same time that the Fed's changing the Fed funds rate, all right? So this, and I hope everybody can, really kind of see this. You can see there is a ton of correlation between the Fed funds rate and 30-year mortgage rate. So this is showing you the red line on this graph. This is the Fed funds rate, okay? So in 2009, 2010, you can see it obviously got lowered pretty well. And you see mortgage rates did kind of trend down, right? And there were, there were a little bit of spikes here and there. But basically it's you can see that's not a direct thing because if the correlation were direct, this blue line would follow exactly this red line. That's not the way it works, right? It's basically the same factors that causes the Fed to change Fed funds rate are the same factors that mortgage people purchasing mortgage-backed securities are looking at. So, so if we understand the relationship between the Fed and mortgage interest rates, this will help you better answer that question. Okay, so what causes mortgage rates to go up in theory when the Fed increases rates? The same reason that the Fed is increasing rates is the same reason that mortgage rates are increasing. Okay, when the Fed met this last time and raised the Fed funds rates, everybody in the whole world knew inflation was a problem, right? Like you may or may not remember this, but last year there was a big discussion among economists and Fed members as to, is this inflation transitory or is it more long-term? And what they were basically saying is this just simply an overreaction to the unwinding of what took place in 2020? And is this going to fix itself in the next 5 to 6 months, maybe 12 months, or is it more long term? There was a little bit of debate last year. I don't know that there's been much of a debate this year. I think most people this year go, you know what, inflation's a problem, and it's going to continue to be a problem if we don't do something about it. Okay, so here's the crazy part about the Fed meeting, the Fed quote unquote raising rates. All right, and what can happen, and a lot of times does happen with mortgage rates. Believe it or not, a lot of times mortgage rates will ease back down after the Fed increases the Fed funds rate. Well, why would that be, right? That seems kind of silly to think that would be the case. Here's the thing. If the Fed increases the Fed funds rate enough that the market feels like they are doing what's appropriate to control inflation, you will see mortgage interest rates kind of level off, possibly even go down right after the Fed increases the Fed funds rate. Okay. Now, it's not, that doesn't happen all the time because, again, the same factors that's causing the Fed to do that to begin with are the same factors that's pushing mortgage interest rates up. But I can tell you this, if the Fed met, and they're not going to do this and I wouldn't even be a proponent of it, but if the Fed met again in 2 weeks and said, you know what, we're going to make extraordinary measures and we're going to raise the Fed funds rate a full 5 points. Okay. So it's going to be 5.5%. So now home equity lines of credit are going to be 8.5%, the best priced ones, right? Credit cards are now going to be at 18% interest. You would probably see mortgage rates creep down. Why? Because I think most people in the market would go, the Fed's nuts. They are about to throw us into one of the biggest recessions ever. Okay. And people are going to be looking for safe investments, right? Now, the Fed's not going to do that, right? Because they know that the reaction in general from the market they wouldn't take that very well. But your stock portfolio would not be sitting well. I'd say most people would say it's not sitting well this year anyway. But yeah, I mean, that's what I'm saying. If the Fed does enough to tame inflation, you'll see mortgage rates level out. You'll see mortgage rates probably even decrease a little bit. Okay. Now, to get back to something that we talked about earlier, how else does the Fed influence mortgage rates? And this is a biggie, is they purchase mortgage-backed securities. All right. And so let's get to the next slide because this actually goes right into what we're talking about. Why were rates low in 2020 and 2021? Okay. Because understanding why they were low then will help you to understand what's going on now. Rates were low in 2020 and 2021, especially 2020s, because people thought the economy was shot. People are like, this is insane. You can't shut down for however long there's a shutdown. There's going to be, a long-term effect for this. And listen, there may still be. I mean, we're not to the point that we can look back and truly do an autopsy of 2020. But basically, rates were low because everyone felt like there was problems with the economy for the most part. The Fed was purchasing a lot of mortgage-backed securities. All right, a lot of mortgage-backed securities. And I don't know that they ever came out and just flat out stated this, but I think the implied thought process was they wanted rates to be low because they wanted home buyers to have lower payments. They wanted people, I do think actually some of the Fed members actually made this comment. They wanted everybody in the country to refinance, right? Because they were concerned about the economy. And the one thing they didn't want to have happen was they did not want something like 2009, 2010 to take place, okay? And it did not, and this is not the same market, but still, that was a concern. And so how do you potentially offset that? Well, let everybody have a lower payment. Then it's easier to make payments. Then if they're working a little bit less, they can still make their payments. Because you may or may not remember this, but in 2020, one of the huge concerns was forbearance, right? Where home buyers would not be making mortgage payments. Well, you know what? There's somebody not getting paid on that deal. So that's a problem if it's, a long-term thing. That's a problem if a lot of people participate in it. So the Fed was looking for ways to hopefully keep people from having to do that. All right. Now, that was 2020 and 2021. What happened in January of 2022? The Fed basically came out and said, here's the deal. We think inflation's a problem. We're taking the training wheels off. We are not going to be purchasing mortgage-backed securities like we have been. As a matter of fact, there was even some talk that they might start selling off mortgage-backed securities. Okay. And so the way it works with interest rates is this: it's supply and demand, meaning this: when the Fed was buying a lot of mortgage-backed securities, that means they were basically competition for the private market that wanted to purchase mortgage-backed securities. What happens when there's a lot of competition? Well, you know this with home prices. They go up, right? Well, with mortgage rates, when the cost of mortgage-backed securities goes up, the net effect, and I'm not going to bore you by explaining this, but the net effect is rates come down, right? So you want a lot of people purchasing mortgage-backed securities if you want lower interest rates. So what was happening was the federal government was buying, a boatload of mortgage-backed securities, and other private investors that wanted to purchase mortgage-backed securities, they had to compete with the federal government, so they had to pay higher prices, causing rates to come down. So what happened in January of 2022? The Fed said, we're not doing that anymore. As a matter of fact, we might start unloading mortgage-backed securities. And the reason why they're doing that, well, it's pretty simple. They're concerned about inflation, right? So what happens is now other purchasers of mortgage-backed securities, they don't have the same amount of competition. And they know that everybody's concerned about inflation. They're concerned about inflation. They're wanting to hedge against that. They need a higher return. And they can get a higher return because guess what? There's not the federal government that's purchasing the bulk like they have been. So that's essentially what took place in January of 2022. And since then, you've seen interest rates rise. I've done this 20 years. I've never seen a 2-month period like we've seen in the past 2 months. It is what it is. I can't change it. I don't control it, but it's been incredible, to say the least. So, but that's basically what's taken place, and that's what happened, like I said, starting around January of 2022. So when you are talking to your clients and they say, well, I heard the Fed's meeting, I'm concerned that they're raising rates, you can say, you know what? Actually, that may not be a bad thing for mortgage rates. If that's your concern, that's probably a positive thing, okay? Because understand this, if the Fed chose not to do anything, we're still going to have inflation problems, okay? So them not raising the Fed funds rates does not change inflation problems. Them raising the Fed funds rates, potentially, depending on how much they do it and when they do it and all that jazz, but potentially that helps stem the problem, all right? So where are rates headed? I have no idea. And I apologize if you sat here this whole time hoping I was going to give you a good prognostication or whatever, but I don't know. Nobody knows where rates are headed. I do kind of feel like that what's taken place the past couple of months has been a resetting of the market. And I feel like it's probably about where it needs to be right now. Meaning, I think this is where interest rates would have gone to in 2020 if we hadn't had the pandemic. I remember at the end of 2019, rates had started rising a little bit. The economy was doing well. And, everyone kind of felt like, hey, you know what? Economy's doing well. Interest rates are probably going to rise a little bit. So, it's conceivable that had the economy, had we not had the pandemic and had the economy continued to grow, it is very conceivable this is where we would have been anyway. We just weren't there in 2020 and 2021 because the federal government stepped in and said, I'm not going to let that happen. We're going to make sure that interest rates stay down. Okay, so where are they headed? I don't know. I will say this. I don't think they're headed lower anytime soon. Okay, at least not this year probably. So do I think they're going to go up at the same pace over the next 2 months that they've done the past 2 months? I don't think that because I think now everyone's aware that the Fed is on it as far as making sure that that inflation is under control. Now, what if we have a recession? Okay, personally, I think that we will have a recession sometime over the next couple of years. I think mortgage rates will come down if we do have a recession. All right. So, basically what I'm telling home buyers right now is And I put a video out, I think this morning, and I can send it to you, but I put a video out this morning that talked about recessions and home prices. And listen, if we have a recession, home prices are not coming down. Okay. So I had a conversation with a buyer earlier today, and I just told him point blank, I said, hey, just so you know, home prices aren't coming down. Now, do I think they're going to appreciate it at the same pace over the next 2 years? No, I don't think that at all. They might, but I don't think they will. They're not coming down. So whatever the price is today, if you don't like it today, you're not going to like it 2 months from now. All right. And if we have a recession, home prices are not coming down. It's happened one time, and that was in 2009, 2010, and that was totally, totally different. Okay. All right. So takeaways for today. All right. And I'm trying to think of stuff that I know your clients bring up, so you can kind of talk to them about it. The Fed does not control interest rates, but they do have a big influence. Okay. If the economy stays strong, that likely means mortgage rates will continue to rise. Okay. And the kind of asterisk there is if inflation continues to be a concern. If we do have a recession in the future, that likely means mortgage rates will decrease. That's not a guarantee. All right. So what's the best strategy your client has about higher rates is purchase a home today. Okay. Because here's the thing, home prices will continue to go up. So if someone says, you know what, I think there's going to be a recession a year or two from now, and I know mortgage rates are going to be a little bit lower then, so I'm going to wait until then to get a lower rate. Here's the problem with that. Home prices will continue to go up. So here's a better strategy. Buy your home today at today's mortgage rates, okay? If there is a recession a year or two from now, and it makes sense, refinance your loan, all right? But that's an extraordinary bet, in my opinion, to sit back and say, I'm going to wait 2 years or a year or however long. I'm going to wait for a recession. I'm going to hope that the one thing that probably is not going to happen happens, and that is home prices come down, and then I'm going to take advantage of it. That is, in my opinion, an extraordinary bet, okay? Because here's the problem with that. That probably ain't going to happen, all right? And the whole time that person's waiting, if they're renting, their landlord is cranking the rent up, all right? Companies are buying homes right now to turn around and rent them out because they want to charge higher rent, all right? They're not doing that to have rent control. So that's not a good bet for your client. So the best strategy is, if it makes sense for somebody to buy a home today, they find a home they like today, if they can get it under contract, let's buy it today, all right? If rates go down in the future, great. You can refinance it, get a lower payment. That's awesome. You know, we certainly encourage people to do that, but we don't encourage people to sit around and wait for that, because that's probably not going to happen. So thank you, everybody, for hanging out this whole time. Thank you to Brittany for keeping everybody, letting everybody in from the waiting room. I did record this, and I would be more than happy to get this out to anybody that wants the recording. And of course, if you've got specific questions that you want answered, I'm always happy to talk, and always happy to talk to your clients if they've got questions. So again, I don't want to take up your whole day. I know everybody's busy. Thank y'all very, very much, and y'all have a great day.